This is not a normal market move. This is not a healthy rally. And this is not something that can be explained away with a simple headline or a single economic data point. Silver moving decisively above $7 is a signal that something much deeper is happening beneath the surface of the global financial system. When silver behaves this way, it is not responding to optimism. It is responding to stress. It is responding to imbalance. And it is responding to a system that is slowly losing its ability to control outcomes. Silver has always been different from other assets. It is not just a metal, and it is not just an industrial input. It occupies a strange and uncomfortable position between money and necessity. It is used in electronics, energy systems, medical equipment, and infrastructure. But it is also historically linked to currency, savings, and trust. That dual role makes silver uniquely sensitive to systemic pressure. When confidence in paper systems weakens, silver does not wait for permission to it reacts violently. What makes this move so alarming is not simply the level itself, but the speed and structure of the move. Markets that are functioning normally do not allow silver to climb in this manner. Under normal conditions, silver is restrained by layers of derivatives, paper contracts, and institutional positioning designed to smooth volatility. When those restraints fail, it tells us that the paper mechanisms used to control price discovery are under strain. This is not a story about speculation. Retail traders do not have the balance sheet power to move silver like this. This is not a story about hype or social media enthusiasm. This is a story about forced decisions being made behind the scenes. When silver rises sharply and relentlessly, it usually means someone is no longer able to remain short. It means margin calls are being triggered. It means risk managers are stepping in. It means positions that were once considered safe are suddenly becoming dangerous. Silver is one of the smallest major markets in the world relative to its importance. The physical market is thin, inventories are limited, and the leverage built on top of it is enormous. For every ounce of physical silver, there are multiple claims layered on top through futures, options, ETFs, and structured products. This structure works only as long as confidence remains intact. Once that confidence cracks, the system becomes unstable very quickly. When prices move slowly, participants believe they can exit positions in an orderly way. When prices move fast, that illusion disappears. Liquidity vanishes exactly when it is needed most. That is when markets stop behaving rationally and start behaving defensively. The move above $75 suggests that this defensive behavior is already underway. There is a temptation to explain this away with macroeconomic narratives, inflation expectations, energy transition demand, geopolitical uncertainty, or currency debasement are often cited as reasons. While all of these factors exist, they do not explain the timing or the intensity of this move. Structural demand does not cause sudden stress does. Silver tends to move less. It remains quiet while pressures build elsewhere. It absorbs strain while larger markets attempt to mask instability through liquidity injections, policy statements, and accounting adjustments. But when silver finally breaks free, it often means that other systems have already reached their limits. This move is occurring at a time when global debt levels are historically extreme. Governments are running deficits that would have been considered unthinkable a generation ago. Central banks are trapped between inflation and instability. Raising rates threatens solvency, while lowering rates undermines currency credibility. This is not a balanced environment. It is a fragile one. At the same time, trust in financial institutions is quietly eroding. Banking systems are more leveraged than they appear on paper. Derivative exposure remains opaque. Counterparty risk is underestimated during calm periods and rediscovered during stress. Silver does not need a banking crisis to rise, but banking stress accelerates its behavior dramatically. Another critical factor is the breakdown of traditional correlations. Assets that were once assumed to hedge each other are now moving unpredictably. Bonds are no longer reliable stabilizers. Equities are increasingly sensitive to liquidity rather than fundamentals. Currencies are being used as policy tools rather than stores of value. In this environment, silver begins to behave less like a commodity and more like a referendum on trust. When silver crosses levels that were previously considered unreachable, it forces a reevaluation of assumptions. Price models break, risk limits are breached, and participants who believed volatility could be managed suddenly realize that control was an illusion. This is why silver moves are often accompanied by confusion rather than celebration. There is also a geopolitical dimension to this move. Global trade is fragmenting. Supply chains are being strategic resources are being weaponized. Silver, as both an industrial input and a monetary metal, sits directly in the path of these shifts. When access to materials becomes uncertain, price becomes secondary to availability. That is when traditional valuation frameworks fail. What makes the situation more dangerous is the lack of visible stress elsewhere. On the surface, markets may still appear orderly. Equity indices may not yet reflect panic. Credit spreads may not yet be flashing red, but silver does not wait for confirmation. It often moves ahead of visible crises, acting as an early warning rather than a reaction. This is why dismissing this move as speculative is a mistake. Speculation creates noise. This move is signaling tension. It is signaling that leverage is being unwound under pressure rather than by choice. It is signaling that liquidity is thinner than advertised. There is also the issue of physical availability. When prices rise quickly, it is often assumed that supply will respond. But silver supply is not flexible. Most silver is produced as a byproduct of other mining operations. It cannot be ramped up quickly in response to price. That rigidity means that once demand exceeds available inventory, price becomes the only balancing mechanism. As prices rise, they also expose vulnerabilities in paper-based exposure. Instruments designed to track silver rely on assumptions about liquidity and settlement that hold only in calm conditions. When volatility increases, those assumptions are tested. Redemption pressures grow, counterparty risks emerge, and confidence begins to fracture. This is not about predicting where silver goes next. It is about understanding what has already happened. A market that was assumed to be controlled has demonstrated that it is not. A system that relied on leverage and confidence has shown signs of strain. That alone is significant. That historically sharp moves in silver have coincided with periods of broader instability, not always immediately and not always obviously, but consistently enough to matter. Silver does not cause crisis. It reflects them. It surfaces information that other markets suppress. The danger now is complacency. After an initial shock, markets often attempt to normalize abnormal behavior. Commentators search for explanations that restore comfort. Analysts adjust forecasts. Volatility is reframed as opportunity, but the underlying conditions do not reset. So if silver is able to hold these levels or continues to move higher without consolidation, it suggests that the forces driving this move are persistent rather than transient. That persistence would imply ongoing pressure within the financial system rather than a single event-driven reaction. It is also important to recognize that policy responses are limited. Central banks can influence interest rates, but they cannot manufacture trust. They can inject liquidity, but they cannot eliminate leverage without consequences. Each intervention trades one risk for another. Silver responds to those trade dash-offs. The move above $75 should be seen as a warning, not a forecast. It is a message from a market that rarely speaks loudly unless it has to. It is a signal that the balance between paper claims and real assets is shifting. What happens next will not be determined by headlines or predictions. It will be determined by whether the system can absorb the stress without cascading effects, whether confidence can be maintained without further intervention, and whether participants believe that stability is real or simply maintained by narrative. Silver has delivered its message. The question now is whether anyone is listening